Have you ever wondered if the common financial advice you've been following your whole life might actually be holding you back? Well, welcome to Dollar Playbook. I'm Taylor Reed, and today, everyone, we're diving into a step-by-step explainer on exactly where to put your money first to build a truly stable life. We're going to look at a master blueprint for your dollars. To really grasp why this matters, let's look at two hypothetical guys, Jake and Marcus. Jake, he absolutely hates debt. He refuses to invest a single dollar until every debt he owns is completely gone, following that classic advice to pay off everything before you invest. Marcus, on the other hand, well, he loves investing. He opens a brokerage account and starts buying stocks immediately, even while carrying a balance on his credit card, because he believes that time in the market beats timing the market. You know, both of them genuinely think they're being incredibly responsible.
But here's the shocking reality. You have to ask yourself, how did two men with the exact same $90,000 salary both manage to lose over $500,000 in potential wealth? Seriously, there were no wild, reckless gambles here. Their massive loss had absolutely nothing to do with what they invested in. It had everything to do with the order they did it in.
It all comes down to the financial order of operations. So let's walk through this blueprint step by step. We'll cover the $500,000 mistake, building safety nets, eliminating high-interest debt, optimizing tax shelters, finalizing your investments, and lastly, calculating the true cost of order.
All right, Section 1, a $500,000 mistake, the power of order.
You know, people will debate for hours over whether to buy index funds or real estate, but then they fund their accounts in whatever order feels good that month. That is a massive mistake. Think of it like this. Every dollar you earn is like a worker looking for a job. Sometimes that best available job is erasing a guaranteed loss, and sometimes it's grabbing free money from your employer. The trick is, when you put a dollar in the wrong job, you don't get a flashing error message on your phone. You just quietly earn less for decades. Our goal here is to make sure your next dollar always takes the absolute highest paying job available.
Moving right along to Section 2, Safety Nets and Free Money. Steps 1 and 2.
So, where does this master blueprint actually begin? Well, before investing a single dollar in the market, you need a boring cash buffer. We're talking about 3 to 6 months of living expenses sitting safely in a regular bank account to protect you against catastrophes. You know, like a car breaking down or a sudden job loss. If you don't have this, emergencies will literally force you to sell your investments or, worse, go into credit card debt. Once that safety net is built, you move immediately to Step 2, capturing your employer's 401k match.
Capturing your employer match is the highest paying job a dollar will ever have. Why? Because it provides an instant, guaranteed 100% return. If your employer matches your contributions up to a certain percentage, and you put in $4,500, they give you another $4,500. Your money literally doubles before it even hits the stock market. Leaving this on the table is just a mistake with zero upside.
Section 3. Eliminating high-interest debt. Stop bailing water.
Once you've secured that match, your next dollar gets a new assignment. Let's talk about credit cards. The average card charges north of 22%. So if you're carrying a balance, it is actively destroying your wealth. Paying off a debt that charges 22% isn't just competing with the stock market, it's beating it, absolutely guaranteed. It is a risk-free, tax-free 22% return on your money.
Our honest long-term expectation for the stock market is about a 7% return after inflation. So the rule is pretty simple. If a debt charges you more than the honest 7 or 8% you expect from investing, you absolutely must clear it before moving on. Actually, this is exactly where Marcus made his costly mistake. He was investing to earn 7%, while his credit card charged him 22%. It's like bailing water into a leaky bucket. To clear these balances, you can use the snowball method, paying the smallest balance first for that psychological momentum, or the avalanche method, tackling the highest interest rate first for pure math.
Which brings us to Section 4, optimizing your tax shelters. Steps 4 and 5.
With the bad debt finally gone, it's time to legally shelter your wealth. Now, you might wonder why we don't just dump more money into the 401k yet. Well, you open a flexible IRA first because workplace plans often have hidden fees. Think about the difference in final balances over a lifetime of investing. Over 30 years, a 1% fee leaves you with $812,000. But a low-cost IRA with a fraction of a percent in fees leaves you with $966,000. Those hidden fees can quietly eat up over $153,000 of your hard-earned wealth.
Next up is Step 5, the Health Savings Account, or HSA. If you have a high-deductible health insurance plan, the HSA is literally the only account in America where money goes in pre-tax, grows tax-free, and comes out tax-free when used for qualified medical expenses. It is a triple tax-advantage stealth retirement weapon. If you leave it invested and just pay for current medical bills out of pocket, it compounds untouched for decades. It's a real game changer.
All right, Section 5, finalizing your investment strategy, steps 6 and 7.
Now that your highest-paying jobs are filled and your primary tax shelters are optimized, we handle the heavy lifting for your later years. For Step 6, you go back to max out the 401k. Doing this lowers your taxable income right now, which is incredibly powerful during your peak earning years. Once you've completely filled that tax-advantaged space, and only then, you move to Step 7, opening a regular taxable brokerage account.
The taxable account belongs dead last. Why is that? Well, because of tax drag. In all those other accounts, your money grows completely untouched. But in a taxable account, the tax collector takes a small bite out of your dividends and gains every single year. Over 30 years, that small leak can cost you around $141,000, compared to keeping it in a tax shelter. You definitely want to avoid that for as long as possible.
Section 6. The true cost of order. Running the take.
So we've gone through the blueprint. Let's bring this all back to Jake and Marcus to see exactly what ignoring this strict mathematical sequence costs them over 30 years. The optimal order finishes with $1,477,000. Jake's stubborn hatred of a low-interest 3.25% mortgage meant he delayed investing for 15 years. That cost him around $548,000. Meanwhile, Marcus's eagerness to invest while ignoring his 22% credit card debt left him at $882,000, a mistake costing nearly $595,000.
The math is absolutely undeniable. Doing the exact same financial steps out of order literally cost you $500,000. Both Jake and Marcus thought they were making really responsible choices based on common advice, but the lack of a proper sequence quietly drained their potential wealth. It's wild to think about it in those terms.
The vital takeaway here is that you don't need to stress over picking the next hot stock or timing the market perfectly. You just need to follow the blueprint. Boring, done in the right order, is what quietly beats almost everyone who is chasing something exciting. It's practical, it's calm, and it works for sure.
Every dollar you earn is an opportunity. When you let money sit in the wrong step of the sequence, you're quietly leaking potential. Understanding this financial order of operations isn't just about avoiding mistakes. It's about making sure your hard work actually translates into real, long-term stability and growth.
So, I'll leave you with this provocative question today. Look at your own finances and honestly ask yourself, is every dollar you earn working its absolute highest paying job? Fixing that order today can absolutely change your life tomorrow. If you found this explainer helpful and you want to keep building a stable, prosperous life with us, please take a moment to like, share, and subscribe to Dollar Playbook. I'm Taylor Reed. Thanks so much for tuning in, and I'll catch you in the next one.